Okay, let's dive right into this explainer and uncover the hidden mechanics of building real, multi-generational wealth by studying the silent rich. We all know the usual cliches of wealth, right? The flashy cars, the designer labels, the VIP tables at clubs. But as the data and historical blueprints actually reveal, the absolute loudest person in the room is usually the one drowning in the most debt. So today, we're decoding the actual operating system of the truly wealthy. We're going to pull from centuries-old laws of capital all the way up to modern-day market strategies, mapping it all out to give you a concrete, no-nonsense blueprint for true financial independence. Picture two identical driveways on the exact same suburban street. Both homeowners earn $140,000 a year. Now, one driveway has a brand new $65,000 European SUV sitting there on a loan, which is eating up nearly 25% of their take-home pay. They are strapped entirely into the golden handcuffs. The other driveway? Well, there's a paid-off 6-year-old sedan sitting there. That second person is taking that $1,200 monthly car payment and dumping it straight into a brokerage account. They aren't buying status, they're buying a war chest of freedom. 60%? Man, this terrifying number represents the EMI debt trap ratio that slowly destroys your wealth before you even get a chance to truly live. Recent data shows that a massive chunk of urban professionals are handing over nearly 60% of their salary to monthly installment payments. Car loans, personal loans, credit cards, you name it. And the harsh reality? You simply cannot out-earn a 60% debt ratio. Even if you get a big promotion, the math just doesn't work out. So, here is our roadmap for today's explainer. We'll start with the fake wealth trap. Then we'll cover the silent rich mindset, followed by navigating the financial markets, the $250,000 milestone, and finally wrap it up with the old money blueprint. Okay, part 1, the fake wealth trap, the vanishing salary. Let's get into it. It's absolutely crucial to understand how high interest loans quietly siphon away your earning power right beneath your nose. Take the classic 10-year trap. So you're looking at a 14-lock car loan at a 9% interest rate. When you extend that loan from 3 years to 7 years, the monthly payment drops, which, let's be honest, feels incredibly great at first. But the total interest paid tells the real story. You end up paying hundreds of thousands more for an asset that is actively depreciating. In the first 3 years of that 7-year loan, you're essentially paying top dollar for a car that has already lost 60% of its value. It is literally wealth destruction disguised as affordability. And it goes way beyond formal bank loans. These sneaky recurring payments completely blindside us. We call this the invisible EMI trap. It's the buy now, pay later schemes on random online purchases, the 4 different streaming subscriptions you totally forgot to cancel, monthly insurance premiums, and of course the ultimate wealth killer, credit card minimum payments. Paying only the 3% minimum on a credit card charging 45% annual interest means a tiny little balance can take 22 years to clear. Crazy, right? These push your actual debt obligations straight into the danger zone without you even realizing it's happening. Moving on to part 2, the silent rich mindset, stealth wealth. The thing is, true millionaires don't perform their wealth for an audience. They calculate opportunity costs, and they deeply value what we call extreme low urgency. When we look at the actual math behind stealth wealth allocation from a study of over 200 saver investor millionaires, a really strict spending pattern emerges. By keeping their housing at 25% or less and their transportation incredibly thin at just 5%, the silent rich redirect massive amounts of capital straight toward their freedom. 50% right into savings and investments. They don't buy a house to impress the neighbors or lease a car for the office parking lot. They live below their means deliberately, not reluctantly. These behavioral signals prove that true status isn't about flashy logos, but rather the calm peace of mind that comes from a deep financial safety net. The truly wealthy operate with what we call low urgency energy. When a flight is delayed or a pipe bursts in the house, they just don't panic because a problem is just a minor logistical inconvenience solved with a phone call, not a financial catastrophe. They speak in the future tense, planning decades ahead, and they prioritize quiet quality over loud, super visible luxury. I'd rather be rich than look rich. This quote comes from a modestly dressed man earning $40,000 a month, and it perfectly summarizes why the loudest person in the room usually has the most debt. Get this, he owned 38 properties, but looked like he'd been wearing the exact same jeans for years. He fundamentally understood that every single status purchase you ignore is another brick in the wall of your financial fortress. All right, part 3, navigating the financial markets, tools of the trade. Saving is just step 1, right? Understanding the mechanics of different financial markets gives you the leverage to actually multiply those savings. Knowing exactly when to park cash for quick liquidity versus when to invest for long-term growth is a fundamental dichotomy for any wealth builder. Money markets, think treasury bills and commercial paper, are short-term, highly liquid, and really low risk. Capital markets, like shares and bonds, are meant for long-term growth and capital formation. The wealthy use both of these seamlessly. They use money markets for their unshakable cash cushion and capital markets for their main wealth generation engine. And for those looking at more active trading within global markets, there are Forex CFDs, or contracts for difference. Basically, these are trading contracts that allow investors to speculate on global currency price movements without actually owning the underlying currencies. There are platforms out there like BitGet that allow users to navigate these global currency fluctuations and leverage automated executions entirely without holding the actual asset. The foreign exchange market operates almost 24/5 across Asian, European, and American sessions. But remember, and this is key, the wealthy use these advanced tools with strict risk control and institutional level management. They never, ever confuse high leverage trading with their core long-term wealth protection strategy. Credit itself is a really powerful tool when viewed correctly. Think of credit cards as a ladder. Level 1 is just a basic credit builder, but as you move up to levels 4 and 5, you unlock things like airport lounges and robust travel insurance. By the time you reach level 6 or the mythical level 7, the card is no longer just a financial product. It's a symbol of a private banking relationship requiring millions in investable assets. Moving up this ladder requires treating credit as a highly disciplined tool, paying balances in full every single month, and absolutely not as free money. Which brings us to part 4, the $250,000 milestone, the tipping point. Hitting $250,000 invested changes the game completely. It transforms you from a mere saver into a manager of a self-sustaining income engine. Over time, the returns on your investments begin to naturally outpace your actual monthly contributions through the sheer unstoppable force of compounding. Even at a very conservative 5% return, a $250,000 portfolio generates over $1,000 a month in purely passive growth. At this stage, your money has enough mass to grow meaningfully all on its own. It's the tipping point where your wealth stops being a mystery and starts being purely mathematical. But with greater wealth comes the absolute need for hyper-efficiency. At this level, a simple 1% management fee can cost you thousands of dollars annually. So protecting your returns from taxes and fees essentially becomes your primary job. You really must become a fee detective. Move into low-cost index funds with expense ratios under 0.2%. You also need to practice asset location, putting high dividend assets in tax-advantaged retirement accounts to legally shield your hard-earned income from the tax man. Finally, part 5, the old money blueprint, 500-year wealth. To truly understand the modern trust structures that allow elite families to keep their wealth intact across centuries, we have to look back. These rules from ancient Babylon are the exact same operating system used by highly successful investors today. Number 1, save at least 10% before you pay anyone else. Make it compound, protect it fiercely, don't invest in things you can't explain to a 10-year-old. And lastly, never chase impossible, flashy returns. Human psychology around money hasn't changed in 4,000 years, and honestly, neither have the rules for keeping it. To avoid the infamous shirt sleeves to shirt sleeves in 3 generations curse, wealthy families embed financial education deeply into their family culture. Normal wealth disappears entirely because the first generation builds it, the second maintains it, and the third generation spends it recklessly. But families operating on an old money blueprint maintain their wealth for well over a century. They do this by treating their family wealth as a permanent, unbreakable institution rather than just a personal piggy bank. By living strictly off the income generated by trusts and never dismantling the core engine, the wealth naturally compounds indefinitely. Law number 1 of old money: you never touch the principal. You do not take apart the engine to fuel the car. Law 2, focus on protection and mitigating loss before ever chasing growth. And Law 3, multi-decade financial education for the kids, so the wisdom transfers right alongside the money. Protection always comes before growth. This old money mantra is a stark reminder that the cost of comprehensive insurance and robust legal structures is always, always cheaper than the cost of losing absolutely everything. The silent rich, they don't ask how much can I make first. Actually, scratch that. They ask how much can I lose, and exactly how do I prevent that, with genuine curiosity and extreme caution. So I'll leave you with this provocative thought to ponder. Are you pricing your purchases in dollars or in the precious years of your life? The next time you think about upgrading your car or your house just to impress people you don't even know, think about the real price tag. Ask yourself, how many months or years of mandatory work you are trading for it. Because at the end of the day, true wealth isn't about looking rich. It's about buying back your life. Thanks so much for joining me on this explainer, and I hope it helped you decode the silent blueprint to true financial freedom.